Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. Once again, I'm sorry. I keep hoping this may not take as long as recent weeks, but please be prepared, as this may take some time, I'm afraid. Firstly, I wish to set out the market's overall picture. The reason this may take some time is there is no simple solution here for what is a very complex problem. The bear channel for the February to June action, which is highlighted on my daily chart in bright red, had been the most significant pattern this year. 8 weeks ago, the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by closing over a number of important resistances, notably the 50% absolute Fibonacci line at 682. The move over the 50% absolute Fibonacci line was intrinsically important, but it was also important in another sense, as it was the gateway to the congestion band from March and April between 682 to 721, within which sits the January 2021 high at 693 and the old October 2013 high at 721. 6 weeks ago, prices followed on even higher by utilising the medium moving average, currently 671, as a base for an attempt up into another congestion band dating from December last year through to February this year, between about the March 2014 high at 725 up to the lesser Fibonacci line at 799, and containing within it the January 2022 low at 739 and the May 2014 high at 744. The market made it up into this congestion band, pushing up over the March 2014 high and even over the one piece of resistance coming down into the market at that time that any market would not usually have trouble in overcoming. And that's the slow declining long moving average, currently at 719. Prices punched down through the long moving average on 2 separate occasions in June, but did not close over it. Okay, so this is where I reprised my discussion point from 5 weeks ago, not only to discuss it as a point, but later to bring it into this week's action. Okay, so I said 5 weeks ago, and I quote, "Whether I have named a specific level or one of the most stunningly accurate pieces of technical analysis I have done in a while, or else someone was taking the mickey." You see, for a few weeks now I've been talking here about a bear channel, highlighted in bright red, that I mentioned earlier. Last week, so that is now 6 weeks ago, last week I even finessed the point further by specifically highlighting a topside level. This is what I said, and I quote, "Thus a primary target X would be in the 770 area, only a little above where we have reached, but the secondary target X1 will be a lot higher in the 855 area, and there is quite some congestion overhead, and one important downtrend, the March 2022 to date downtrend, and that's currently at 791. This is the one based on the ultimate high of this market, but we'll have to see if the market can achieve target X first." Well, as you can see from the daily chart, the high in late June after I gave this original commentary was in the 770 area, specifically 770 and a quarter. Thus, target X was achieved and the market immediately turned and fell away. I do not believe that to have been a coincidence. I suspect it was another technical analyst who also came up with the same conclusions I did and acted upon them. Or alternatively, it could just be the market taking the mickey. In any case, I was grateful to see target X achieved. Since then, the market moved back below all the supports that had earlier been resistances and have now again become resistances. It fell down to the significant neckline extension, currently at 650, of the small October 2020 to November 2020 head and shoulders top, which is highlighted in purple on my daily chart. This neckline has a fairly wide congestion area clustered around it, formed from late April to mid-July between about 609 and 679. This congestion lasted for about 2 weeks at the start of July, supplying the market with enough ammunition for a try higher before prices made another attempt upwards 3 and 2 weeks ago. That rally from the neckline and also over all 4 moving averages moved all the way up to the 770 target X area again, exceeding it this time before the phantom technical analyst out there, or Mickey Taker, take your pick, chose to cap it 2 weeks ago as a new recent high, one not seen since February, and done interestingly with a 3-day bearish evening star pattern. That's going to come up a lot in this conversation. We also came the closest to the previously mentioned significant March 2022 to date downtrend, currently at 799. As a side note, the secondary hard reach target X1 for the bear channel is still there at 855, and I'll let it stay there for the moment. Okay, so the move back down from the interesting 3-day bearish evening star pattern at the top saw a drop down through all those supports once more that became resistances again. In the process, the market has seemingly supported another pattern I'd earlier laid out as an idea and put forward one, maybe up to 3 others. So 2 weeks ago I put forward the idea that the action since late May to mid-July is a bullish shift pitchfork. I've highlighted the bullish shift pitchfork, which is in bright green on my daily chart. So far this pattern continues to work with a halt last week and this just above the lower time, currently at 648. There's also seen a generation of other potential patterns. The first I'd like to discuss is an unusual one. It's one that immediately springs to mind but looks in the wrong place, and that is to see the whole of the late May to date action as a possible double top with a neckline at the same purple extension of the small but influential October to November 2020 head and shoulders top, currently at 650. The second one is a little more rare, and it is to regard the same action since late May as a possible rising 3 valleys pattern, with the base of the action on the lower tine in bright green, which happens to be synonymous with the late May to date uptrend, currently at 649. Aesthetically, this second pattern looks to me more appealing, but it also has its own issues. I wish for the moment to just lodge these ideas in your mind before expanding upon them further or retiring them completely, and maybe bringing back the old descending scallop idea back again. However, I do note that next week the neckline and the lower tine cross over, which should provide an interesting point to watch, and by late October the lower tine and the downtrend from March 22 will also cross over. Chicago corn. Back in early to mid-June we saw a remarkable recovery that carried on into the 3rd full week of June. Prices punched up through the older congestion at 548 to 556 and 561 to 567 like they were not even there, along with the more recent congestion from early May between about 580 to 600. This congestion, as I said 8 weeks ago, and I quote, apart from being recent, it is also not that strong, and it would not be surprising to see a move higher towards the wide band of stratified congestion from February to April between 610 to 640, end of quote. In addition to the congestions, the market also punched up through the short medium moving average, currently at 528, then the medium moving average, currently 558, as well as the late February to date downtrend, currently at 578. All these congestions, along with the 610 to 640 band, slowed and eventually turned the market back down, without the need of relying on the more substantial capping action of the descending long moving average further up, currently at 609. Now, the pullback lower at the end of June and into July had been similarly remarkable. I even speculated on there being a possibility of a descending scallop pattern 7 weeks ago. Interestingly, this seemed to be on the cards in early to middle of July, when we saw the market hesitate before turning back upwards. Now, I commented on this 6 weeks ago thus, and I quote, "At the moment the market is being held up by the combination of 2014 high and the 61.8% absolute Fibonacci line at 506. At 525. This is not enough, nor is the October 2021 low at 516, nor the lesser Fibonacci line at 506. Only when we may see prices down within the congestion between 486 to 498 that contains the 2021 low at 498, only then can we start looking at this potential descending scallop pattern as having been formed." End of quote. Well, prices did fall down to the congestion between 486 to 498, and 4 weeks ago the market formed a pipe bottom and shot back up again, penetrating all the resistances and halting temporarily at the July 2013 high at 563.5, with a pipe top, for on Monday 2 weeks ago prices once again moved higher, but only as far as the descending medium moving average, currently at 558, before once again heading back down below the congestion between 548 to 567, and below the recent 50% Fibonacci line at 549, gapping below the combined 2014 high and 61.8 percentage absolute Fibonacci line at 525, below the October 2021 high at 516, and down to where we are now and have been since late last week at the 490 to 498 congestion, as well as the 2021 low at 498. 2 weeks ago I said, and I quote, "Looking at this action, there is no way that this action since late June could be seen as a descending scallop pattern, no matter how much I optimize it. Once again, for a second week, I'm going to take a short step back and wait and see what the new pattern will develop here." End of quote. Well, upon reflection, the action since late June could indeed be still seen as a possible descending scallop pattern, and we may be about to see the completion of that pattern, with the possibility of its resultant move. However, be ever cautious. This is not an easy pattern here, and there may be something else available. And in this, I looked last week at the action since mid-May to possibly be a descending wedge pattern, currently 466 to 542. I haven't highlighted this pattern. This pattern is not yet complete, and as a girth about it, I'm not too comfortable with, given its duration, but it still stands out. So for a second week, watch to see what happens at this 490-498 congestion. You never know, maybe both ideas will work together. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.